Hey, what's going on YouTube, and welcome back to Tech Conversations. I'm your host Guillermo. It is May 24th. Hope you're all having a great day today. The market is very green. As you can see, we're up over $1,000 or about 1.07% today. So pretty great day in the market. We'll see what the rest of the day brings us. Now in today's video, I want to talk about an options trading strategy that's very cheap to implement and that also has a very high chance of being profitable. So before I jump into this strategy, guys, all I ask is that you guys hit the like button down below and subscribe. It really helps out the channel. So first, what we're going to talk about quickly is what our goal from this strategy is, and then what type of market forecast we want, what types of stocks we want to be using with this strategy. So our goal is going to be to profit from a sharp move, either up or down on the underlying stock with limited risk. Okay, so in other words, the market forecast that we're looking for here then is going to be a rather volatile market. And so the stocks that we want to use for the strategy then should be stocks that are highly volatile, stocks that are going to move quite a bit. And the good thing is that we don't really care which direction it is. It doesn't matter if it moves up, if it moves quite a bit up, or it moves quite a bit down, as long as it moves and doesn't trade sideways. And so events that you could capitalize this strategy with would be, like earnings, major product announcements, FDA approval news that's coming up. These are the types of events that will send stocks either flying higher or completely tanking. So anyways, we're going to find a very volatile stock for this strategy. So I'm going to use UAL for this strategy here. This is just an example. It's just a random stock I'm choosing, United Airlines. So let's just pretend that, I think United Airlines is going to make a pretty big move in the next week. And, I'm not sure if it's up or down. I just think it's going to move from where it's currently at. So what I'm going to do is I'm going to go over to the options here for United Airlines. And now that we've found this stock that we think will move substantially in the next week, we can actually set up this strategy. So here's what we're going to do. So I think this United Airlines stock will move substantially in the next week. So what I'm first going to start by doing is I'm going to buy one at the money call option. So remember, at the money means where the strike price is as close to the share price as possible. Share price right now is $56. $55.98, $55.98.99. So 56 then here is going to be the closest of these strikes that's as close to the share price as possible. So what I'm going to do is I'm going to buy this at the money call option. Now for buying this call, I'm going to have to pay a premium. I'm going to have to pay about 86 cents per share. Remember, each contract controls about 100 shares. So I have to pay about $86 to buy this at the money call option. Now what I want to do is I want to buy a put as well. And that put will also be at the money. So again, where the strike price is as close to the share price as possible. That's also going to be the 56 strike. So for buying this put, I'm going to pay about 85 cents per share or about $85 for this contract. So I'm going to go ahead and do that. So that alone by itself is a long straddle. We've talked about that before, but that's not what we want to do here. What we're going to do now is we're going to go ahead and we're going to go to sell now, and we're going to start by selling an out of the money put. So remember, out of the money for puts is where the strike is lower than the share price. So since these strike prices are less than the share price here, these are out of the money. These up here would be in the money. Okay, so we're going to sell one out of the money put. So that's going to be the ones down here. And so I'm going to just choose the one right below the strike of the put that we bought. So I'm going to go ahead and sell the $55 strike put here. Now, when you sell an option, you receive a premium. So I'm receiving 46 cents per share. Again, there's 100 shares in each one of these contracts. I'm going to receive $46 here. Now what I'm going to do next is I'm going to sell a call here. And this is going to be an out of the money call. And again, out of the money for call options is actually where the strike is higher than the share price. So these are out of the money. These would be in the money. So I need to sell a call up here that's out of the money. But one thing to note here is that the strike difference from the put you're selling to the put you're buying and call you're buying should be the same as the strike difference from the call that we're going to sell to the ones that we're buying. So since the difference between these strikes here is 1, the difference between the strikes we're buying and the call we're selling here should also be 1. So I'm going to have to sell this $57 strike. So I'm going to receive about $43, $44 for selling this call option. So this is what this looks like, okay? This is called the reverse iron butterfly. It's the exact opposite of the iron butterfly. So as you can see, this is going to cost me about $81 here. And what's nice about this strategy is that our max loss, of course, is going to be defined. We know what the most that we can lose here is, and it's going to be the debit that we're paying to enter the trade, which again would be about $81. And our max profit is also going to be limited. And I'll talk about here shortly how we can quickly calculate that without having to, use some of these other calculators we're going to use. Or you can also just take a look down here at this profit and loss graph here that it shows you. But anyways, like I mentioned, I always still recommend to use the options profit calculator to visually see what your profit losses are depending on the date, depending on the price of the stock. So that's what we're going to do. Let's go over to the options profit calculator. So we'll just go under custom. We'll click on 4 legs here. So we'll just set this up from scratch. So again, the symbol here for United Airlines is going to be UAL. So we'll go ahead and enter UAL here. We can click on get price. This will load the price of United Airlines right now. Now there is a small delay on the options profit calculator, so be aware of that. So let's just do the exact same trade we just set up over there. So again, make sure your expiration date is correct. May 28th, we bought an at the money call. So at the money was $56 strike here. And then calls are on the left, puts are on the right. Be careful with that. So we're going to pay about $99 here. And then we're going to go ahead and buy a call or a put here and at the money one as well. So 56, which is right there. And then we're going to go ahead and we're going to buy or not buy, sell or write an out of the money put option here. So we chose the 55 strike for this, and puts are on the right here. And then finally, we're going to write or sell the out of the money call option. And we chose the 57 strike, so right there. And then we'll just go ahead and calculate this. Let's see what this gives us here. So entry cost, $82, and that's a net debit. So again, we're paying to enter this trade. We're paying about $82. Maximum return is going to be $18 here. And it gives us our break evens. And look at the probability of profit, almost 75%. That's a pretty high probability of being profitable. And you can kind of take a look at this graph here, right, to kind of take a look at where you're going to be profitable. So again, this is the exact opposite of the iron butterfly, guys. So as you can see, our max risk of 82 will happen if on the expiration date, this stock basically trades sideways. If it basically hits the strikes of the call and put that we're buying, right? So that's why you kind of have to make sure that you believe that this stock will truly make a substantial move in the next week, because we don't want it to just trade sideways, because if it does, that's where you're going to end up losing the most you can lose here, $82. We want it to move substantially either up or down. And actually on expiration, if you hold through expiration, it doesn't actually have to move that much, because again, our break evens here are 55.18. So if it's at 55.18 or below, you're either breaking even or making money, or if it's at 56.82 or above, you're breaking even or making money. So again, as long as this stock is a volatile stock and it's moving in either direction, you're going to make some money. Now you may say, well, you're risking $82 to only make $18. That's not a huge return. But I mean, that's still a 22% return in 1 week. And you need to remember that the average investor only makes about a 12% return per year. So if you're making a 22% return a week, that's a really, really good return. And again, this is a very high chance of being profitable strategy here. And again, you can kind of see where this would happen, right? On expiration, even before expiration, you can make that max profit. Again, the only thing we don't want to happen here is for the stock to trade sideways. We want it to go up or go down. We really don't care which way, as long as it's volatile and moving in either direction. So definitely, kind of play around with this, move the strikes further so you can kind of see how that affects the probability of profit and your max return, max risk, things like that. So anyways, this is the reverse iron butterfly. Now, a couple of things to note here. Number one is commission costs, right? If we go back here, we are, opening, and then we're going to have to close 4 different contracts. If you're on a broker that has commission costs, that can definitely end up costing quite a bit and eat a lot of your profit away. Of course, Robinhood has no commission fees, so we don't have to worry about that. But if you do have a broker that does, make sure you keep that in mind. Make sure that the risk to reward ratio still seems favorable there. The other thing, of course, is the risk of early assignment. We are selling options here. Anytime you sell an option, there is risk of assignment. Now, assignment before expiration is very rare, but it does happen. Now, early assignment is generally related to dividends, and more specifically, if the stock you're selling options on has the ex-dividend date on the week that your contracts expire. So make sure that you're always checking the stock, check to see if it has a dividend and when that ex-dividend date is. If that ex-dividend date lies on a week that you want to sell options on, your best bet is to not sell options on it that week to risk early assignment, or just close out 2 days prior. So short calls are assigned the day before the ex-dividend. Short puts are assigned the day of the ex-dividend. So I just recommend closing 2 days prior to the ex-dividend date any options you sold, just to avoid being assigned early, guys. And of course, I know some of you guys are going to ask me, well, how do I close this trade? You would close it by implementing the iron butterfly using the exact same strikes, right? So you'd basically do this exact same trade, but any option here that you're buying, you would instead sell that option, and any one that you're selling, you would buy that option. And I also have a video on how to close any trade. So anyways, this is the reverse iron butterfly, guys. Let me know what you guys think of this strategy. If you have any questions, feel free to leave them in the comments section below. Check out the Discord, link to it in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.